AccuPlan, and I'm very excited that I'm going to be joined by Hollis Day of Sage Financial Group and Tim Wright of American Safe Retirement. Guys, say hi.
Hey, thanks for having us on today. We appreciate it.
Yes, yeah. Ron, thank you very much.
Thanks for coming on. Today we're going to talk about investing in life settlements with your IRA or 401k. I will be talking about the IRA and 401k side of things and leaving it up to Hollis and Tim to give us a good education on life settlements and investment opportunities with life settlements. A little bit of housekeeping. Everybody that's on here as an attendee will be on in mute. If you have any questions for us, please feel free to write it in the chat box in the GoToWebinar menu, as well as hitting the question box, which will allow you to write the question in, and we'll get to those at the end. So I'll be speaking for roughly 15 minutes or so, and then I'm going to turn it over to Tim and Hollis for the rest, and we should have some time for Q&A at the end. I'm also recording this, so if you're not able to stay on the whole call, I will have a recording link. If you email me, I will be able to provide that for you. Okay, let's begin. Legal disclaimer before I get do not provide investment, endorse any product. This is an educational webinar. All parties should consult with their financial advisors before entering into any type of investment. So now that we got that out of the way, let me get about myself and AccuPlan. Again, Brian Davis, I'm the Director of Business Development for AccuPlan here in San Diego. I've been with AccuPlan for the last 2 years, just about, and I've been in the self-directed IRA space for about 5 years. I was with a different custodian prior to that. My background, my parents are rice farmers up in Northern California, so I've always had kind of an entrepreneurial spirit. Went to college at UC Santa Barbara down the coast here in California. I graduated in 2001, moved to San Diego early 2002. Got into doing loans. I was a loan officer through 2007 here in San Diego. And those of you watching at that time know that a lot of the real estate market started to crash at the end of 2007, which kind of caused me to switch paths. I got into life insurance and annuities for a year or two before finding the self-directed IRA space, which I found really intriguing, and I hope to teach some of you guys a little bit more about it today. And now that I'm with AccuPlan, we're one of the nation's premier providers of administration products for IRAs and 401ks. Generally take about 2 to 3 days for moving an investment or funding an investment when people direct it to us with a low annual fee. We have our own trust company called American Estate and Trust, which allows us to be an IRA custodian so that you can direct your IRA investments. So let's talk a little bit about self-directed IRAs. For those of you that don't know, this area kind of started with the ERISA plan that IRS passed in 1974. This outlined what we see today with IRAs. This said you have to have an IRA custodian to move your retirement account investments, and those investments are going to be tax deferred if they're in some type of pre-tax IRA like a traditional IRA. And later on, when Roth IRAs came around, allows for those plans to be tax-free. Our space is dominated by the investment banks and insurance companies that offer stocks, bonds, mutual funds, ETFs, and annuities in case of the insurance companies. But really, when the ERISA guidelines were written, there was a much wider range of investments. So you had to go to companies like us to take those investments on. Give you a little bit of background of what's in IRAs right now. This is an older slide. I should get this updated. But there was about $5 trillion just in IRAs at the end of 2010. 98% of those are with traditional brokerage houses and insurance companies in those traditional investments. Now this number of 2%, the last I heard, is growing to closer to 4%. There's been a lot of people jumping into the self-directed IRA space with education being much brighter out there on the internet. When Mitt Romney was running for president a couple years ago, when his financials came out, it came to light that he has a self-directed IRA worth somewhere around $100 million. So with people seeing, whoa, $100 million in a retirement account, maybe I should be looking at some other alternatives. So it's a growing space, and people are doing a lot of investing with self-directed IRAs. These are the normal asset classes that we're seeing here at AccuPlan. People investing in real estate, notes, some precious metals, and then private companies. And you'll see that the life settlements is kind of set up into a private company that you invest in through the life settlement, and I'll let the experts, Hollis and Tim, talk a little bit about that during their piece of the presentation. The IRS never made a list of acceptable investments. You can see here a huge list, and this list could go on and on and on. You can invest in rental properties, raw land, lease options, joint ventures, promissory notes, again, on and on and on. The IRS basically listed when they wrote the tax laws on it, there's only two things that your IRA could not invest in, and that's life insurance contracts and collectibles. And this is a list of different types of collectibles according to the IRS. And there's even some exceptions, as you see here, where they do allow some coins. But, rug collections, art collections, antiques, those aren't allowed. And life insurance contracts, again, when we're talking about life settlements, as you hear, it's being set up as a private placement. It isn't that simple, though. There are some other little tricks here where your IRA can't invest in what's called a prohibited transaction. Prohibited transaction is when your IRA gets involved with a disqualified person. So I know I'm using a lot of jargon here, so let me try to clean that up. And again, I'm getting this from the tax code itself, Internal Revenue Code Section 4975. This talks about who's a disqualified individual from your retirement plan, and you are. You're prohibited from having any personal dealing with your IRA, as well as your spouse. And then you want to think about this in a straight line up and down. You've got parents, grandparents, kids and their spouses, grandkids and their spouses, or even companies that those people own. So your IRA is not allowed to benefit any of those people. The real basis of this is there's no self-dealing in your IRA. So you don't want to get involved in one of these prohibited transactions, because the IRS can go back at any time if they were to audit you and see one of these prohibited transactions and disqualify that whole IRA at the time of the prohibited transaction. So if you have questions about this, that's what I'm going to play a little game here. So everybody might remember the game Deal or No Deal from NBC a few years back. Try to make this a little exciting for you as opposed to being monotone and being boring here. But how about this? Can your IRA lend yourself $10,000? Deal or no deal? That's no deal. That's self-dealing. So if you go back and look at the rules, that would be self-dealing. That's something that's a no-no. What about your brother? Could your IRA lend your brother $10,000? Deal or no deal? That one's deal. He doesn't fall in that line of being straight up and down. He's on the side. So your brother is not technically a disqualified person from your IRA. You might have other reasons you might not want to lend your brother $10,000, but I'll let you make those decisions. And your stepson, could your IRA lend your stepson $10,000? Deal or no deal? That one's deal. In the IRS's infinite wisdom, son would be no deal, but because he's a stepson, they're considering that that's okay. Again, it gets a little tricky. What about this one? Daughter-in-law. Can your IRA lend your daughter-in-law $10,000? Deal or no deal? That one is no deal. Your children and their spouses. So again, it gets a little tricky. So if you have questions about this, let me know, but you really want to make sure what your IRA, who your IRA is investing with before you get into an investment. The next piece is, all right, I get it, I think. How do I put money in one of these self-directed IRA vehicles? Well, self-directed is a marketing term that we use because we allow people to invest themselves and invest in everything allowable under IRS guidelines. So just like the brokerage houses and insurance companies, we have traditional IRAs, we have Roth IRAs, we have SEP IRAs, and we even have something called a solo 401k plan. And I'll cover those in a second. But how do I move money from one IRA to another? We do what's called a trustee-to-trustee transfer. So we move your cash from your existing IRA custodian over to us so you can have more control of your investments from there. If you have like an old qualified plan, like a 401k or 403b plan, you're going to want to contact your administrator and request a direct rollover. A question I get here all the time is, Brian, well, what about my current company's retirement plan? Can I move those funds over to a self-directed IRA? The answer to that is maybe. A lot of the qualified retirement plans that people are in at their work, they don't allow you to move money to another retirement plan until you leave the company or they close down the plan. However, there are some plans that do allow something called an in-service rollover. And if your company plan allows an in-service rollover, you can move those funds over to an IRA, whether it be self-directed like one with us or with the main brokerage house. So that's something you might want to ask. And the third and final way to put money into an IRA is through an annual contribution. And you'll notice, even though we're at the end of March already, I have 2013 contributions up here, and that's because people have until generally they do their taxes to make a contribution for 2013, so there's still time. So if you want, you could still make a contribution to a traditional IRA of up to $5,500 or a Roth IRA in the same amount. If you're over the age of 50, you can throw in an extra $1,000. Now that's what most people fall in line with. They can have a traditional IRA or a Roth IRA. Now there's also some different types of retirement plans for, small companies. Now a simple IRA works very similarly to a company 401k, but it's for small businesses. It allows employees to put some money aside and the company will match. The contribution limits are much smaller than the 401k, however, and the rules are IRA rules, not 401k rules. Don't see those plans often. What I do see a lot of is the SEP IRA and individual K. The SEP IRA is for the self-employed individual and their employees, if they would like. They can contribute up to 25% of their adjusted gross income to one of these plans with a cap at $51,000 for 2013. You actually have until October 15th potentially to make your contribution to a SEP IRA if you did an extension on your taxes till October. In 2014, the limit for the SEP IRA is increasing $1,000 to $52,000. The other plan I touched on is the solo 401k or individual K. Now this is for the self-employed individual with no W-2 employees, and it's part of the 401 rules out there. So most people are familiar with the company's 401k, but if you're a self-employed individual with no employees, you can have your own 401k plan. And that plan, you can be the administrator and trustee of the plan. Now it's a lot easier to make that annual contribution of $51,000 to one of these plans as a SEP IRA because you can make contributions as the employee and as the employer to get to that plan. And I might cover that more in a second. If anybody has any questions, please feel free to write them in the chat box or put the question bars. One thing I do like to talk about is a lot of people ask me, well, Brian, I like that I can self-direct these investments, but sometimes I want to go to like an auction or be able to make these investments myself and not go through the custodian. And that's where a checkbook IRA comes in. And the prevailing method here is the IRA establishes an entity that it owns. That entity can be an LLC or a business trust. Just for sake of time, I'll just go through how it works with a business trust. The IRA becomes the beneficiary owner of the trust. The IRA owner becomes the unpaid trustee. You would then direct the IRA custodian to move your retirement dollars into this business trust, which you would open up your own bank account for, and then you can make those investments on your own. If people want to learn more about that, they can check out my website, retirementcheckbook.com, for more information about the business trust. Now, I bring up the checkbook control IRA because the solo 401k, one of the benefits to that is it comes with checkbook control already. Essentially, you're buying a plan document, the 401k plan document, and you can attach it to your corporation. It doesn't matter if you're just a 1099 or you've incorporated. From there, you're going to be the trustee and administrator, and you can directly hold investments in the 401k plan. and our plan document allows these alternative investments. So you can create a company or not. If you already have one, you can roll over existing retirement dollars in it and then make those larger contributions that you can make to a 401k plan as opposed to an IRA. You can do all of these different things in the 1K. You can even loan yourself money out of a 401k plan just like you could a company 401k plan because you are also the plan participant. And again, if people have questions about this plan, please feel free to contact me. Most people fall in line with the IRA method. We can get your account open in a matter of minutes online with an online application, and then we work on funding your account. This is a part of the process that takes the longest. We do one of those transfers, rollovers, or contributions. This can take anywhere from a couple days to a couple weeks depending on how liquid your funds are and which company those funds are with and how quickly they move them for you. And then we take about 2 days to fund an investment. So that's what I have here. Here's my contact information. You can reach me at AccuPlanSanDiego.com or call me at 619-892-2438. And with that, I'm going to turn it over to Tim and Hollis. You guys there?
Yes, Brian, thank you.
Thanks, Hollis. I'm going to turn the screen over here. So again, anybody has any questions right now, please feel free to write them in the chat box or do the question button, and we will get right there for you.
All right, thanks, Brian. My name is Hollis Day. I have a weekly radio show in Baton Rouge, Louisiana, and I've been doing that for several years, and I take a lot of pride in introducing the public, people to alternative investments. And my favorite alternative investment is the asset class of life settlements. I absolutely love, being that guy that is introducing something to somebody new for the first time because most folks are not familiar with life settlements. I was introduced to life settlements by Tim Wright, and Tim is on the call with us. And after talking with Brian and Brian allowing me to introduce this asset class to you guys to talk about life settlements, the more I thought about it, I wanted to get Tim involved. Tim is absolutely what I call an educator, and so he's going to help out with this presentation. And I talked to Tim about it, and he gladly accepted that he would do this for me. So, Tim, with that, I'll turn the presentation over to you.
Great. Thank you very much. Hopefully everybody can hear me loud and clear. Thanks, Brian. It means a lot that you had us on your webinar today. And Hollis, thanks for calling me up and doing something I love doing is educating people on this asset class. So thanks again for having me. Let me just start off by giving everyone – oh, I'm sorry. Go ahead.
I was just saying thanks for being here. Sorry to interrupt.
Oh, I'm sorry. Okay, great. Well, let me just start off real quick by giving everyone just a quick introduction of who I am. I think this will definitely help explain my passion for what I do today. In the past 25 years, I've specialized in marketing and sales, project management. I've also had a real passion toward teaching financial success to others, like Hollis mentioned. And for the past 7 years, I've been a senior partner here at American Safe Retirements. We're based in the DFW, Dallas-Fort Worth area, and we are an alternative investment company that specializes in educating and training financial advisors and their investors on really all aspects related to life settlements. In my previous career, I worked as a vice president and a corporate officer of one of the largest privately held companies in the country, and although that had a lot of excitement, a lot of upside, my passion was always to be on the leading edge of an industry. And if you've done that before, you know exactly how exciting that can be. Well, I jumped into the life settlement industry feet first. I partnered with the architect of this entire industry, actually, which he partnered about 23 years ago. And one of the first things I recognized when I started was that the vast majority of Americans had little or absolutely no knowledge of this asset class. And at the time, approximately 95% of the industry was owned and controlled by major institutions. And I would always think to myself, if this is so great for banks and insurance companies who really own most of it, there needs to be more mid to high net worth accredited investors that own this product in their portfolio. So at that point, the architect of the industry was already making really nice inroads and doing just that, but there was just a lot more to be done, and that's where we came into play. So myself and the rest of the partners here at American Safe Retirements went on a mission. For the past 7 years, have been on that mission to educate advisors and, of course, their clients about this asset class. And we actually call it the best investment that you've never heard of, because once people are taught what it is and they understand exactly how it works, they're kind of bummed, they're disappointed that they didn't learn about it sooner. So I applaud all of you for taking the time today to learn about this asset class. Now, in the email that invited you to this webinar, I kind of went a little extreme, and I noted that Alexander the Great was the world's first real estate investor. Now, I know our definition today of investing in real estate is certainly quite different than it was back in 334 BC. I'm kind of a history buff. But as I noted, there is one thing that hasn't changed, and that is results, getting results. Alexander the Great wanted results, and certainly so do you, whether that's in any investment that you are looking to do. And from what I can understand, and in talking to Brian, the majority of you today on this webinar have or are about to invest in real estate. And by the way, I'm a big fan. I own real estate myself. And with that said, if you're like me, I got into real estate investing because I love the upside, the potential, that feeling of getting the deal and closing and flipping a house or building an inventory of rentals. It's very exciting. So I have nothing disparaging to say about real estate, but the one thing I learned with real estate is that I had to be hands-on, whether I had the time or not. And it's a real dynamic industry, and you must, in the majority of cases anyway, unless you have somebody doing this for you, keep your eye on the ball, because there are a lot of moving parts. I don't want to speak for anyone here, but I think many real estate investors would consider a complementary asset class to invest in if it had similar characteristics. The upside potential, and here's the key, no ongoing management, right? All the headaches. We're all looking to have less Excedrin type moments, right? So as I own real estate for the last 7 years, I jumped into this industry, and I learned that life settlements were interestingly similar to real estate, and I began to invest a large portion of my portfolio over the past 7, 8 years into life settlements, and it's worked out really well. So what I'd like to do is just spend the next few minutes providing you with a really good understanding, a good education of this growing and exciting asset class. We'll define it. We'll learn about its history and legal basis. You'll find out who the key players are, which I think you'll find interesting. You'll understand the characteristics, the structures people utilize to invest in life settlements, and learn how and what types of returns are realistic. So before we get started, let's quickly get a good understanding of what life settlements really are. As you can see here, the definition is pretty simple. A purchase of an existing life insurance policy at a discount to its face. Very simple. But what does that really mean? Well, let me go over just a quick example that will help everyone understand it. Mr. Jones is 65 years old. He owns a $10 million business, and for estate planning purposes, he goes out and he purchases a $5 million life insurance policy, a very common practice with business owners, as you probably know. He spends a lot of money on this policy over the years, but it protects him and it protects his assets and his family estate. If you fast forward 17 years, Mr. Jones is 82, and he sold his business. So he is no longer in need of this very large and expensive insurance policy. And instead of lapsing the policy, he uses a broker, very similar to a real estate transaction, and sells his policy. Okay? So if he lapsed it, he would receive nothing, not a penny. Maybe he would get the cash value, but that would be it. Now, if he had built up cash value, he would receive that. But instead, he finds a broker. Finds a buyer that's willing to. That broker finds a buyer who is willing to pay 4 times what his cash surrender value is. Okay, obviously a huge win, and he's ecstatic, and he accepts the offer. The total acquisition cost of the purchase here is approximately $1.5 million, about 30 cents on the total death benefit. So investors, which could be a hedge fund, could be a pension plan, investment bank, or individuals like you and I now own this policy. Now, of course, we're responsible for the premium payments just like you would be when you own your own life insurance on yourself. But I quickly realized after years, after I purchased a bunch of life settlements, that premium calls were to life settlements like real estate taxes were to real estate. Yeah, no one really likes to pay taxes, but you do, and you continue to invest in real estate because you know it's a great investment. Life insurance premiums work the exact same way. Now, depending upon the structure of the investment, which Hollis can talk to you about multiple structures, those premiums may be escrowed for 3 years, or they may be escrowed for the life of the entire investment, which, again, he can discuss with you on that. Now, Mr. Jones, he lives a great life. He ends up passing away at 87. I think everybody would agree that's a pretty darn good life. At that point, each of the investors would receive their pro rata share of the death benefit, which is a pretty simple formula. Now, this is a win for Mr. Jones, who was able to discreetly liquidate an asset, receiving much more than the insurance company was willing to offer him, which is really key. And certainly a win for each of the investors. Their combined $1.5 million turned to $5 million in 5 years. Not bad, right? Now, it may have gone longer, and in that case, the investors would be required to pay additional premiums, reducing their overall return. But because it was purchased correctly up front, like a good real estate deal, right, it would take 12 to 15 years of paying premiums before you would eat into your principal, 12 to 15 years after the initial investment. Mr. Jones would have been somewhere in the neighborhood of 94 to 97 years old. Now, is that possible? Yeah, it's possible. It's just not real probable based on the medical underwriting on this policy. So I'll give you a little better understanding. Now, I found it important to understand, and I think you will too, what is motivating someone in this situation, Mr. Jones, to want to sell his policy? Well, for starters, selling a life settlement is pretty sophisticated, and you need to be obviously a higher end, mid to high net worth person before you can even entertain the idea of selling a policy. When we looked at what kind of age that we're looking at, we found that 80+ years old is the right age to purchase a settlement because it's easier for doctors to predict life expectancy, which, by the way, is really insignificant, assuming you purchase the policy for the right price. But we're looking for a 4 to 8 year payout window. And working with 80+ year olds in your portfolio minimizes that exposure. And by the way, that 4 to 8 year window marries up nicely with IRAs, because what's the one thing you don't want to do with an IRA? You don't want to touch it for a number of years. You just want to see that investment grow. Well, over 70% of all the investment that we do comes from qualified plans, any type of qualified plan, really. So just like the example I gave with Mr. Jones, where he purchased his policy for estate planning purposes, most, not all, but most of the policies fall into that category. So why would an 80-year-old sell their policy? Well, it really boils down to 3 reasons. They either no longer want or need the coverage, they'll use the money to better their retirement, or they may not be able to afford the coverage. These things are expensive. Bottom line is, this policy they have in their hands has virtually outlived its usefulness, but it has tons of value, which is the beauty of the life settlement industry. So, of course, right now, there are people that are asking themselves, well, how is this possibly legal, right? Well, here we are 2 decades later, $35 billion in business has been transacted. So you know it's legal, but what makes this a legal transaction, Well, in 1911, the Supreme Court ruled in a case called Grigsby versus Russell. I won't go into the details. If you want to look it up, Google it up. It's pretty interesting. But this law enabled policyholders to sell their policy because it was deemed to be their personal property, just like a home, a car, a watch, anything that you own. An insurance policy is yours, and you can basically do anything you want with it. Well, it took about 80 years after this ruling, interestingly enough, before an industry was created. And I call that the insurance company's best-kept secret. You probably agree with me there. But the life insurance industry is a dynamic one, and one of the things that is happening is everything that's occurred, at least in the 7 years I've been in it, happens really at warp speed. And in just 7 years that I've been here, I've witnessed some very exciting changes, but a lot of very positive things that are occurring. Now, if you go back in time 23 years to the early 90s, our industry started with what was called viaticals. Some of you may have heard of viaticals. And as you recall, back in the late 80s, early 90s, AIDS was starting to inflict millions of people. And unfortunately for the victims and their families, it was the closest thing to a death sentence that you were going to get. Those who contracted AIDS were typically younger. They didn't have much of an estate, not much money saved up. But many of them did have smaller life insurance policies. So the viaticals were quite similar to a senior life settlement, but the insureds were much younger, and the life expectancies were typically around 2 years. The insureds absolutely loved this option of selling their policy because this gave them a cash infusion, enabling them to be more comfortable in their remaining years. Well, in the mid-90s, when they rolled around, many drugs started to enter the market, not curing the disease, but treating it, allowing many who were HIV positive to live much longer. Well, this made predicting life expectancies and pricing policies pretty much impossible. So by the mid-90s, viaticals pretty much had gone away. There were a few here and again, but for the most part, that market pretty much had evaporated. But there was one very large viatical company who had helped thousands of AIDS patients, HIV positive patients, and then instead of shutting their doors like a lot of companies did back then, they discovered another settlement market with seniors that really had limited options if they didn't need their policy or couldn't afford their insurance premiums anymore. And in 1997, the first senior life settlement was transacted. Now today, when you add all the business between the major institutions, all the individuals that have purchased, which has been probably around 10% of the whole market, the life settlement industry is about a $35 billion industry. So what's happening with the market today? Well, it's growing, and for good reason, because policyholders are recognizing that the paper their insurance policy is written on actually does have value. Older insureds don't have to see lapsing their policy as their only option, right? Well, it's also growing because people like you and me and many other people that we know are tired of their hard-earned retirement dollars being played with in the market. Many feel as if they're going to Vegas every day with their retirement because the fundamentals that made Wall Street what it was make very little sense today. Billions and billions sit in IRAs and 401ks and are at the complete mercy of market forces, not necessarily the fundamentals of the company that they're investing in. That's how we all learned how to invest in the fundamentals. Well, those are the good old days, right? The markets today don't make sense and are completely unpredictable. And since 2000, the market is up about 2% a year, including this great bull run that we're on right now. And in my opinion, that's not what people signed up for, especially for the retirement dollars. And I know that's exactly why Brian does what he does, looking for alternatives. And it's just not getting the job done. And I applaud all of you because you've already made that first step to work with Accuplan. And that means a lot because you already have the right mindset that the market's just not getting the job done for you. Another reason for the growth in the industry, especially over the past 5 years or so, is due to the increase in regulation. And don't get me wrong, I'm definitely not a big government over-regulation guy, but I do believe that proper regulation brings transparency and can place a spotlight on an industry which certainly helps everyone involved, right? So many are surprised, this is interesting, when we show them who the key players are in this industry, life settlements. The biggest purchaser of life settlements are insurance companies. Now, this doesn't make any sense, right? Or does it? Because, of course, the insurance companies know all too well the strategy works. So they're going out and purchasing policies, and have been for years and years, from other insurance companies. They're not purchasing their own. They're buying it from other insurance companies. AIG is a perfect example of this, and they own literally billions of dollars of life settlements. Investment banks, hedge funds, pension funds, some recognizable names here. Bill Gates and Warren Buffett have massive portfolios of life settlements. If Warren Buffett walked up to you today, and I always ask people this, and they said, hey, would you look into investing in life settlements? I own billions. You'd probably listen, right? Well, here's a guy who literally owns billions of dollars of life settlements, so I always think if it's good enough for Warren Buffett, it's probably good enough for me to at least look at, right? Well, right about this point, some of you may be asking yourselves this question: which side of the equation, and I call it the life settlement fence, applies to me? Is Tim and Hollis wanting me to sell my policy, or are they talking about an investment? And it certainly could be either one, but our expertise is specifically on the investment side of the life settlements. But with that said, it's important to understand both sides of the fence so you see how these policies originate. This slide also illustrates exactly why we're on the investment side, because there's a heck of a lot more people looking for an uncorrelated investment than there are individuals running around with $1 million or $5 or $10 million life insurance policies. But don't get me wrong, there are plenty of policies in the market, but selling your policy can be a real challenge because of the strict criteria that must be met when you look at health conditions and age and all these things. Now, on the investment side, we love the strict criteria, right? We want these policies to be underwritten using a very thorough process that helps us in evaluating the investment and knowing how good it is. So here's a real good question, right? If this is so great, why haven't you heard about life settlements before? Or maybe you have, maybe it's been recent. Well, awareness is definitely on the rise, but the insurance companies will be the last ones to mention life settlements unless they are legally obligated, and in many states, including California where Brian is, and probably where many of you are, it's required by law for an insurance company to do that because these companies want the policies to lapse, right? And I have nothing against insurance companies. I own a bunch of insurance myself. It's there for my coverage. I use it for many, many things. But, of course, they want the policies to lapse. Over 90% of all insurance policies lapse. And if a policy becomes a life settlement, guess what? It's going to pay out, and this eats into the profit. So, of course, they don't like life settlements. So I mentioned AIG just a little bit ago. Well, in 2012, this is from a Harvard report, AIG's life settlement portfolio made up more than half of all the in-force life settlement contracts. They want to keep this to themselves. It's pretty clear, again, as their little secret. Well, it's obviously not a secret, and it hasn't been for many years. So how about this to help increase awareness? Many states have required insurance companies, like I mentioned, to disclose the life settlement option prior to a policy lapsing. Now, here's an example where an insurance company is being sued. Lincoln National Life Insurance Company is being sued because they didn't disclose the life settlement option. And this is becoming a bigger issue from state to state. Most states, or I think it's somewhere in the 20s, maybe it's 22, 24 states, now have laws on the books saying that an insurance company has to offer this as an option. Now, keep in mind, not every one of these policies, in fact, very few of these policies are going to be eligible to actually get purchased. In other words, if you're healthy 35-year-old, no one's going to buy your policy. But if you're 78, 82, 85, well, then there's a possible market for that individual. In 2013, a Texas law was passed where we are here, enabling senior citizens to sell their life insurance policy and use it for long-term care. Here's an article from Long-Term Living that shows that the seniors could receive 10 times the cash surrender value and apply that money to their long-term care, which is, pretty cool stuff if you ask me. So is the awareness increasing? No doubt. No doubt. This was, you see companies like Lifeline on TV now. You start to see other providers that will start to advertise. But I want to have you keep one thing in mind. The insurance industry is a $17 trillion industry, and by far is the biggest industry in the world. There's a reason that they have the biggest buildings in the biggest cities, right? The life settlement industry, on the other hand, is in the neighborhood of $35 billion. So although the insurance companies don't like it, they're going to survive, right? They're going to be okay. This takes a little cream off the top, but like I said, they're going to be okay. Now, is there anyone else that doesn't like life settlements? Yes. And this is really important to understand. Most broker-dealers, the companies that your financial advisor must work through to sell securities, are owned by life insurance companies. Most people don't realize that. So do you think most advisors can offer life settlements to their clients? Probably not. No way, right? Now, they can only offer you products that are approved by their broker-dealer. So if you walked into your financial planner office and said, hey, listen, I just heard this great presentation about life settlements today, and I want to put some money into, take it out of my portfolio and put it into life settlements, what's he going to say? Well, no, because you definitely want to stay away from those. There's no benefit that your advisor is going to have. And this is exactly why I tell people all the time that you need a cabinet of advisors who can help you, because one person just can't know it all when it comes to your finances. I mean, you have Brian, you probably have a financial planner. You're already starting to build your cabinet. But think about presidents, right? They have a cabinet for a reason. They need expertise across a wide range of topics. And you probably wouldn't visit your CPA looking for investment advice, just like you wouldn't necessarily want to talk to your advisor that helps you with stocks, bonds, and mutual funds about life settlements. So the same thing. So build your advisor. Maybe you have a financial person, an IRA person, an insurance person, a life settlement expert, but build yourself your own personal cabinet. That's what I've always recommended. When you take a look around the industry from an individual investment side of things, in other words, not what institutions are doing, there are typically three structures that exist. And this is where you start to learn exactly how we do business. Private placement, which are similar to mutual funds. You're taking literally hundreds of policies and packaging them up into a life settlement fund. The investor would then buy into the fund and have an ownership stake in that fund. Now, there's some real advantages by doing this due to the increased level of diversification, the variety type of policies, and the fact that the fund has a premium reserve system, which greatly decreases the likelihood of a client paying premium payments, which is really attractive. The fund also there's an increased likelihood of liquidity because of age policies in the fund, which Hollis can explain in more detail if and when you were to meet with him. Direct fractional ownership is a very common way of purchasing life settlements because you actually physically touch a fractional interest in however many policies you've purchased. So let's say you've invested in $100,000. Your money would purchase 10 policies at $10,000, for example. As maturities occur, as those policies mature, when that person passes on, that's our nice way of saying when somebody passes away, but matures, you would receive a death benefit of somewhere in the neighborhood of 2 times your investment amount. Now, with direct fractional, investors are responsible for their individual premium calls, so not necessarily a negative, just something you need to plan for and be prepared for. DFO second-generation resales, which are really exciting, are fractional pieces of a policy that someone else bought, say, 3 to 5 years ago. It could be 2 years ago, it could be 7 years, but on average, it's about 3 to 5 years ago. The policy hasn't matured, and the original owner wants to sell it. So the resale buyer is purchasing a policy at a discount that is 3 to 5 years older than when the original purchaser bought it. So you can see the time value of money is really working for you there. And by the way, the private placement is loaded full of resales. The resale ROI is considerably higher due to the fact they're aged and they're purchased at a discount. Since many of you are into real estate and you're investing, I thought it'd be nice to quickly do a side-by-side comparison between the real estate option and a life settlement. And I don't do this to say pick one or the other, really to complement your real estate portfolio. That's really the main purpose of showing you this. Now, when we look at real estate and life settlements, like really any investment, they all have an upside, they have a constant, and they have a potential downside. The upside in real estate, as you know, is the increased property value. Now, that could be rents that you're collecting as well, cash flow positive. And the life settlements, of course, is a known payout. Like the Mr. Jones example, if we bought that policy at $1.5 million, we know the payout's $5 million, a known payout. Now, the constant with real estate, as you all know, are taxes and maintenance costs. The constant with life insurance are premium calls. So they both have that ongoing cost. Some people call that a negative carry investment because they know that they're going to pay as time goes on, and then they're going to get a big cash flow when the policy, in this case, pays out. Potential downside. Well, when we buy a house, we really don't know what the value is going to be. We hope that it goes up. We also hope that another, 08 doesn't roll around, right? The life settlements are unique in this way. They don't have a known term, right? It's not a CD. It's not a stock where I can see it go to $48 a share and sell it. There's an unknown term, and I think you all know what that term is. It's when somebody passes away. So you have to be prepared for that longevity of, it could be 4 years, it could be 2 years, it could be 8 years, and that's the unknown term. But as long as you're using funds that you don't need to touch for a long period of time in that window that we're talking about, it's really a good program. So you can see here the similarities between the real estate and the life settlements. The one thing that I liked about the life settlements over the real estate, and by the way, still own a bunch of real estate, is just the lack of headaches that I get. Listen, the life settlement investment is probably one of the most boring investments that you'll ever have. There's not a lot of sizzle. It's not a real sexy thing. It's really just a boring investment. You're basically watching paint dry. That's what I always tell people. So let me just briefly, in these last few slides, just share with you the characteristics of life settlements. This is going to give you a really good idea of how to evaluate. Then I'm going to give you an idea of how to evaluate life settlements, and then we'll talk about what types of returns are realistic. So I'll go through these pretty quick. The life settlement characteristics, they always should be backed by the top-rated insurance companies in the United States, not different countries, the United States. Unaffected by market volatility. Another huge, well, it's probably the biggest attraction for most of our investors. And by the way, we have about 30,000 investors total over the last 23 years that have invested in life settlements. And it is a nice feeling to know that I can go and I can basically be completely unaffected by and have uncorrelated assets with life settlements, where everything else, stocks, bonds, real estate even, geopolitical events, they affect my retirement account whether I like it or not. Depending on the structure, you can have a lot of diversification or little diversification, but it's all diversification away from your current portfolio, say 10, 20, 30% of your current portfolio. It is a 4 to 8 year hold, like we talked about. It is considered a growth vehicle. It's not an income vehicle. Longevity risk, what do I mean by that? Well, if you're planning on having a 4-year investment, well, it might go 6 years, it might go 8 years, it might go longer than 8 years. So you have to understand that there is longevity risk. As long as you understand that, that's fine. Known payout, talked about that already. No parity of risk. Most investments have a parity of risk, right? A CD or a money market account has low returns, but also has low risk. Well, how about if we have an investment that has CD, money market type returns, or excuse me, risk, but yet on the flip side, it has CD, money market type risk, okay? Or I'm sorry, hedge fund, those types of investment type returns. So that's the no parity of risk, where we can get a little bit of both. I can get the nice returns, but I can also pick up that low risk that we all want in our investments. Premium calls, part of the investment. I've beat you up enough on premium calls. You know all about them. Historic double-digit returns. The company that we use actually does have audited results, and you can see exactly every single policy that's ever matured, and it can break it all down, which is really something that I would encourage you, if you get into this industry, that you make sure that you have a track record, that you have a company that can show you their results. Be better if they were audited, but make sure that you can see those results. The illiquidity of the investment, similar to the longevity risk, is that this is not money that you want to use that you might be sending your kids off to college or putting the pool in next summer. Illiquidity is something that's part of this investment. Although there is a secondary market, as I mentioned earlier with the resells, what are those people doing? They're taking a discount to sell their investment. Increased regulatory oversight is something that I personally like, because when I first started in this industry, it was kind of the Wild West. Now that's not the case. Socially responsible. The people that invest in life settlements are truly doing a true service for all the people that they're buying policies from. Because if it weren't for you, the investors, they would have really no other option, right? Take the cash value out and lapse that policy. So a big area that Hollis can discuss with you is understanding the companies that are involved in the process, right? So nothing real earth-shattering here, but it's critical that investors who get involved are working with companies, like I mentioned a minute ago, that have proven track records. Over the years, just like in any industry, there are life settlement companies that have come and gone, and although the provider involved is really just like brokering the sale. In other words, they're just like a real estate agent in the process that you would work with when you're buying a house. So they don't own an interest in the house, just like a provider wouldn't own an interest in the policy. You still want to make sure you're dealing with a company with audited results and has that level of transparency. You also want to work with a company that has a proven track record of underwriting to ensure policies are actually going to pay out. This is obviously critical, right? We use a company, for example, that has a 32-gate underwriting process. So it's not just one or two things they're checking. It's a whole team of people that are checking all steps to make sure that policy is going to pay out. They've been doing a great job for over 20 years. Now, not that you're personally doing this, okay, like you do with real estate, but you need a company that understands how to purchase the policies at the right price. In other words, you're not negotiating like real estate. So like real estate, you don't want to have to overpay. You're making your money when you purchase on the front end. So each policy that is purchased will be profitable for 10 to 15 years after an investment. Not that it will be not necessarily go that long, but the likelihood of eating into your principal is very small. This is a real key component of the investment. We discussed premium calls a number of times. The key is just understanding which structure is good for you, and Hollis can explain that. It hasn't been until recently that the media has started to become more open and positive about life settlements. You know, due to the newness and uniqueness of this investment, there wasn't always a bunch of real rosy and positive things written about it. So if you're an online reader and happen to run across an article that's not so favorable, I would ask that you take it with a grain of salt, because there will be positive articles right behind it. Also keep in mind the insurance industry in Wall Street. This is a big thing. Again, not big fans of life settlements. They have a very large impact on the media. Obviously a lot of money behind them. So what types of returns are realistic? I always kind of like to leave this near the end so you kind of get a flavor for what the industry is all about and how it works, and then understand what kind of returns are realistic. 6 to 8% annualized returns. Annual audited returns have been in excess of 10%. And I have just one of the pages of the annual audit with the company that we work with that basically shows what those annual returns have been. Now you're going to see on this that the annual return is much higher than 6 to 8%. It's much higher than 10%. But the one thing that we do, and we teach and train all of our advisors to do, is really make sure we're being as conservative as we possibly can. So, you know, hopefully we can come in and be much higher than that, which I think we have and when we do. But that's basically why you see that. Remember, it's a 4 to 8 year window, and it's really perfect for all qualified plans. Now, some people might say, well, gosh, how difficult is it to invest in life settlements? One of the things that I loved about it initially was there wasn't a lot of moving parts. It was simple to understand. People got it. Obviously, using a qualified plan is preferred. You know, we'd recommend that you use a qualified plan, especially if it was in a Roth. You know, the transparency throughout the process is really a neat thing to see, because you get to see your own website, you get to see your own money flow from escrow agent to custodian to escrow agent, and see that money going to work for you. And then at some point, as that money gets funded, you're going to receive ownership of multiple fractions. Let's say if you're doing direct fractional, or you're going to receive an ownership interest in the fund, which again, Hollis can talk more about that. So at this point, what I'd like to do is go ahead and hand it over to Hollis, and he can talk a little bit about how you can learn more about this process. But again, I want to thank Brian, and I want to thank Hollis for allowing me to go through this. Hopefully I didn't talk too fast, but you said you recorded it, so people could always go back and listen to it if they want to see it again. So thanks, you guys. I really appreciate you letting me get on today's webinar.
Thank you.
Thanks, Tim, for that. It's an outstanding job on educating the asset class of life settlements. You can contact me. I have a website called SageMoneyRadio.com. That's Sage, S-A-G-E, SageMoneyRadio.com. I have a quick 5-minute video on there that actually Tim helped put together on the website. I have a little tab that says 5-minute video that you can watch. Obviously, Tim just went into a whole lot more detail than what the video does. But or we can do a conference call, webinar, we can Skype, and see if this is a strategy that you want to learn more about. And again, you go to that last slide, Tim. My email address is hollis@sagefg.net. There's my phone number there. And I look forward to answering any questions that you have. And if anybody has any questions now, maybe they can type it in or go from there. And Brian, I thank you for the opportunity to present this today.
Hey, no problem. Thank you for being on, and you guys had a lot of information. I really appreciate it. I hope everybody got out of it what I got out of it. Quick question I got about when will the recording be provided. Send me an email in a few hours or tomorrow. I should have the recording by the end of the day, and have a link for people to watch. Let's see. Is there a minimum investment, or did I miss that in the presentation? I'm being asked here, Hollis. Is there a minimum investment amount?
Yes, we like the minimum to be $50,000. Because that is just a good amount that spreads over the DFO or going into the private placement.
Okay.
I mean, obviously, the more policy that you own, the better. So the DFO investment would be in 5 policies at $10,000.
Got it. All right. I don't have another one up just now. I know we're approaching 1 o'clock already. Unless something comes up, I really want to appreciate everybody for staying in there today during the lunch hour here on the West Coast, and for the middle of the day for those of you back east. And I should have a recording for this later, so just email me, Brian Davis at Accuplan.net, and I'll be able to provide that. And Hollis, Tim, thank you so much, and we'll look to do this again down the road.
Thanks, Brian, for your time. Appreciate it. Thanks, everybody.
We got one more question popped in at the end.
Yep.
What would you be the main source for this type of investment, or is there other locations? So that's directed towards you guys, I believe.
Well, the key to this investment is the sourcing. So whether it's the fund or whether it's direct fractional, we're not the originator of it. We do work with a national-based company that's publicly traded, been around, like I said, for 2 decades, and so they are the provider, and that's where we get our product from. Hollis and myself both act as really advisors for the product.
Got it. Good stuff. And guys, if I get any more questions, I'll make sure to email them to you. Otherwise, thank you, everybody. Thanks for the time. We've hit 1 o'clock, and feel free to contact Tim, Hollis, or myself with any more questions. Thanks, guys.
Thank you.
Thank you. Bye-bye.